Is Robinhood screwed? Well, maybe, because the SEC might be throwing a grenade at their business model because they're thinking about banning payment for order flow. And the reason that's so big for Robinhood is because it is a majority of the revenue that they're bringing in, and so that would really hurt the stock. Now, in this video, we're going to be talking about what exactly is payment for order flow. I want to talk about the impacts to both traders and long-term investors. Alright, so what exactly is payment for order flow? Essentially, a broker like Robinhood sells your order to a third party, and in return of selling that order flow, they get compensated for directing that order through the third party. And these third parties include wholesalers, market makers, exchanges, institutions. These are the third parties that are willing to pay in order to get that order flow, and in different ways, they can essentially make money from it. So let's go through an example where you're going through Robinhood looking for a good stock to buy, and you run across AMC. The thing looks pristine, so you go ahead and buy 5,000 shares like a true animal. Now, you go ahead and put that order through Robinhood, but what Robinhood ends up doing is taking those 5,000 shares and rerouting those orders to a third party. That third party is in charge of actually executing the trade, and the third party goes ahead and pays Robinhood a certain amount of dollars for that order flow. Let's say you want to buy those 5,000 shares for $39.15, so you put in an order for that, and what ends up happening is the market maker that bought a ton of order flow from a bunch of different people essentially sees they can buy 5,000 shares at an average price of $39.13. So what they do is they end up buying all those 5,000 shares from other people for this amount, and goes ahead and fills your order at $39.15, and they split the difference. So they take the 5,000 shares and take the difference between these two amounts, and that would be their profit. In this scenario, you could have gotten price improvement and maybe gotten filled at that $39.13 if it was routed and the trade execution got you a better fill. But in this case, more of that money is going towards the people that are paying for that order flow. So that information is extremely valuable for people, and there's multiple ways they can make money, whether that's the bid-ask spread. They can really make a decent amount of money when there's market orders, which basically say, hey, I want to buy this stock, but I'm not telling you at the exact price. I'm just saying I want to buy this thing, and market makers and other third-party services can make decent money off of that information. To put things simply, the no commissions and business models like Robinhood exist because of payment for order flow, and it affects customers differently depending on what your investing goals are. If you're an active trader and you're getting in and out of stocks very quickly, or options, basically you are paying these hidden fees through worse fills. One way to avoid these higher hidden fees with market orders is to use something like a limit order. So if you only want to buy a stock if it hits $10, you put in a limit order for $10 per share, and it will only execute if it hits that price. Now, with a market order, really those hidden fees, in a way, you're kind of paying for liquidity. So if you want to buy that stock and you want to own it right now, a market order will get it filled, but you're not going to get the best price. So the more active you are in your trading, the hidden fees kind of add up, versus if you're a passive investor, hey, I don't mind paying 40 cents and basically worse fills versus an $8 commission that we used to pay before this whole business model kind of came up. Also, depending on how much capital you're trading with, you may benefit from payment for order flow, or you're getting screwed over. So in the case where you're buying 5,000 shares of something and there's a 2-cent hidden fee per share, well, your commission was basically $100 because you got screwed over. But with 20 shares in a scenario, well, your impact is only 40 cents. And in a world where the fixed commissions were $5 to $8, well, the winner is the small investor, and the loser is the person that is investing way too much money on Robinhood and should use a platform that isn't using payment for order flow to get better order execution. So if this thing got banned, how much revenue would Robinhood potentially lose? Well, according to their Q2 earnings report, the transaction-based revenues is around $451 million, and total net revenues is $565 for the last quarter. So if we look at a percentage basis, 80% of the revenue is coming from payment for order flow. So obviously not great news if this ends up getting banned. So if payment for order flow gets banned, Robinhood investors are going to have a bad time. The only other revenues coming in would be net interest revenues, which is broken down as follows. You can see a majority of it is due to securities lending and margin interest. And then if you're wondering what the hell this other revenues is at $46 million, in their 10Q, they talk about that being primarily Robinhood Gold, which allows people to basically get higher instant deposits, more research, level level 2 data, all that stuff. And I mean, don't get me wrong, Robinhood isn't the only one that does payment for order flow. I mean, a lot of different brokers moved to this model to get extra revenue, as a ton of them went to the whole no commission route, which brought in a ton of clients, and it's been working out for these companies. So TD Ameritrade, E-Trade, Charles Schwab, Webull, you name it, a lot of these companies are actually in the same boat as Robinhood. So across the board, if you're invested in any of these companies, having payment for order flow be banned isn't great news. Personally, I don't care if there's payment for order flow. Like, if Robinhood's making money off of it and I'm able to still get free trades by putting in limit orders for long-term buy and holds, I'm totally fine. When Robinhood initially came out and they introduced zero commissions, that was a huge stepping stone for the retail investor. From a long-term investor perspective, payment for order flow, in my opinion, doesn't hurt you that badly. It's the ones that are actively trading in and out that are getting hurt on these hidden fees. And really, the long-term retail investor has benefited from the ability to buy in to smaller portions and dollar cost average over a long period of time and not worry about getting absolutely wrecked on the fees. I love payment for order flow, if I'm being honest, as a long-term investor, because hey, no commissions at $8 per trade. Do I think payment for order flow actually gets banned? I don't think so. But if it does, people were messaging me because I put out a story about it yesterday on Instagram, and people were saying, would this mean that we go back to paying commissions? I don't think so. Pandora's box has been opened. People are used to zero commission trading. And if payment for order flow got banned, well, these companies I think would take a hit and possibly subsidize the costs of trading and things like that, or just have less revenues and try to make up for it in Robinhood Gold, margin interest, stuff like that, in order to keep clients. Because if there's one firm that offers zero commission and everyone else is offering $8 per trade, well, guess who's going to get all of those clients? And they'll make up the revenue and lost payment for order flow with all the other features and ways to monetize users. If you did enjoy the video, make sure to smash that like button, as it helps the algorithm and the channel out. Also, consider subscribing to Mainstream Wolf, where we talk investing, stocks, anything to do with money. Thanks guys for watching, and have a great day.